This is Mortgage Morning, and I'm Andy Baker. Here are the housing and mortgage stories shaping the market today. Today is December 29th, 2025. Story 1. Market reality. Mortgage rates remain stable but stubbornly high. Let's start with the most important signal for brokers and loan officers today. Mortgage rates are holding their ground even as the market enters the new year. According to the latest Freddie Mac Primary Mortgage Market Survey, the 30-year fixed rate averaged about 6.18% last week, essentially unchanged over the past month and near the lower end of its recent trading range. Bankrate's most recent lender survey confirms a similar story, with the 30-year fixed sitting around 6.3% and little movement following the Federal Reserve's rate cuts. Here's the nuance. The Fed's nominal cuts matter less if long-term yields stay elevated. Recent bond market analysis suggests that even if the Fed keeps cutting short-term rates next year, long-term yields may remain stubbornly high because investors are pricing in inflation risk and slower bond demand. Story 2. Home value signals. Some markets are softening materially. Our next signal comes from the real economy. Home prices. Recent data from Zillow shows that in the Miami metro area, nearly 3/4 of homes lost value over the past year, outpacing declines seen nationally. Here's what that tells you. The obvious, not all markets behave the same even when rates are stable. Price declines haven't translated into distress. Most longtime homeowners still sit on equity because they bought years ago. But pattern recognition matters. Price depreciation, even modest, can pull buyers forward in the purchase process if they see opportunity. My take, this is a buyer's market signal, not a panic signal. Story 3. Forecast signal. 2026 housing trends show affordability challenges persist. Looking ahead, independent housing outlooks are calling 2026 a critical year for the U.S. housing market. Economic forecast models from Kiplinger show that while mortgage rates have drifted lower over the past months, barriers remain. High home prices, rising property taxes, elevated insurance premiums, lingering affordability constraints. Under current assumptions, only about 38% of U.S. households could afford a median-priced home as of late 2025. The same outlook anticipates modest improvement in affordability in 2026, driven by income growth slightly outpacing home price gains. That outlook suggests two things. Purchase demand is unlikely to snap back purely from rate relief, and competitive originators will focus on structuring strategies that account for taxes and insurance cost pressure, not just interest rates. Story 4. Mortgage rate forecasts. Predictions for early 2026 don't promise relief yet. Mortgage rate forecasts for the beginning of 2026 are nuanced. Freddie Mac data shows the 30-year average is already lower than earlier in late 2025, with multiple housing authorities projecting further slight moderation into early 2026. Some forecasts suggest the first quarter could see rates near 6, while others, including the Mortgage Bankers Association, still expect rates closer to 6.4% based on broader economic conditions and bond markets. What's critical here? Expect modest shifts, not dramatic breakthroughs. Plans built on a rate move of 50 to 75 basis points might leave inventory and pricing expectations misaligned, and the sales cadence will continue to be driven by localized factors, inventory, pricing psychology, job growth, more than the national rate tickers. This forecast context helps you couple data with cadence, guiding buyers through what may be a protracted path to affordability. Story 5. Secondary market and pipeline signals from industry commentary. While direct industry news is light today, the weekly Mortgage News Daily commentary highlights that bond markets remain quiet, and MBS prices showed only incidental movement in the latest session. In secondary markets, quiet does not mean irrelevant. A calm bond market often signals no surge in liquidity stress, less volatility in delivery pricing, and fewer surprise news events disrupting the pipelines. At the same time, other industry data points show sustained refinances pushing warehouse commitments up, and lender repurchases of GSE loans rising, which hints at quality-controlled tightening late in the year. So 5 takeaways for today. 1, mortgage rates are stable but not cheap. 6.18% remains the working reality into year-end and early 2026. 2, market micro signals matter. Areas like Miami showing home value declines are behavioral triggers even if not national distress. 3, affordability remains core. Taxes, insurance, and price pressure emphasize strategy over rate watching. 4, forecasts point to continued modest rate moves. Prepare for incremental change, not game-changing drops. 5, secondary market plumbing is quiet but revealing. Warehouse and repurchase behavior hints at lender risk posture. That's it for Mortgage Morning. If this was useful, follow the show and share it with someone in the biz. I'm Andy Baker. Thanks for listening.